You're about to discover why buying silver at spot price isn't the deal you think it is, and more importantly, what this reveals about where silver prices are actually headed in the next few months. Let me start with something that happened 3 weeks ago that nobody's talking about. A dealer in Texas posted on Reddit that he'd sold over 200 ounces of silver eagles at spot price. Within hours, the post was deleted. Not by him, by someone else. When I dug into this, I found something that completely changed how I view the silver market right now. But first, let's talk about what spot price actually means, because this is where the scam begins. Spot price is the current market price for immediate delivery of silver. It's what you see flashing on financial websites. Right now, as I'm recording this, silver spot is hovering around $29 per ounce. Sounds straightforward, right? Here's the problem. That price exists in a world that you and I can't actually access. The spot price is determined by massive institutional trades happening on the COMEX in New York. We're talking about contracts for 5,000 ounces at a time. When JP Morgan or Goldman Sachs trade silver, they're moving millions of dollars in single transactions. They have relationships with refineries. They have storage facilities. They have logistics networks that have been built over decades. That's the world where spot price exists. You and I? We're buying 1 ounce at a time, maybe 10 ounces, maybe 100 if we're serious stackers. We're in a completely different market. And here's what nobody tells you. Those two markets are separating right now faster than they have in over a decade. Let me show you what I mean with real numbers. Last month, I called 15 different dealers across the country. I told each one the same thing. I want to buy 100 ounces of silver eagles, and I want to pay spot price. You know how many said yes? 0. Not a single one. The closest I got was spot plus $4.50 per ounce. That's a 15% premium over spot. Now here's where it gets interesting. I called those same dealers back 2 weeks later and asked what they'd pay me if I wanted to sell 100 ounces. The highest offer I got was spot minus $2. Think about that. They want to buy from me at $2 under spot, but they won't sell to me for less than $4.50 over spot. That's a $6.50 spread on a $29 product. That's a 22% round-trip cost. But wait, it gets worse. Because some dealers are advertising silver at spot price. You've seen the ads. Buy silver at spot. No premium silver. Spot price silver deals. And technically, they're not lying. They are selling at spot price. They're just not telling you which spot price. Here's how the scam works. There are different spot prices for different products. Silver eagles have one spot price. Generic rounds have another. Silver bars have another. When a dealer advertises spot price silver, they're usually talking about the lowest possible spot price, which is for 1,000-ounce commercial bars. You know, the ones that weigh 70 pounds and cost $30,000 each. The ones that you can't actually buy unless you're an institution. So they get you in the door with the spot price promise, and then they explain that silver eagles are actually $4 over spot. Generic rounds are $2.50 over spot. Even 10-ounce bars are $1.50 over spot. And by the time you're standing there, you've already driven to their shop, or you've already got your credit card out online. And you figure, well, I'm here anyway. Might as well buy something. That's the first layer of the scam. But there's a second layer that's even more important, and this is what that deleted Reddit post was really about. The premiums on physical silver are telling us something critical about the actual supply and demand situation. And what they're telling us is that there's a massive shortage of physical silver that the spot price isn't reflecting at all. Let me take you back to March 2020. Remember when the pandemic hit and everything shut down? Silver spot price crashed to $12 an ounce. $12! The lowest it had been in over a decade. You know what happened to premiums? They exploded to $8 over spot. Some dealers were charging $10 over spot. So you had silver trading at $12 on the COMEX, but you couldn't actually buy a silver eagle for less than $20 anywhere in the country. That's a 67% premium, and it lasted for months. The spot price said silver was cheap. The physical market said silver was scarce. Which one was right? Well, by August 2020, spot price had climbed to $29. The physical market had been screaming that silver was undervalued, and eventually, the paper market had to catch up. But here's the thing. The people who understood this made a fortune. The people who waited for premiums to come down missed the entire move. And we're seeing the exact same pattern right now. Silver spot is at $29. Premiums are at $4 to $5 for Eagles. That's a 17% premium. That's not normal. The historical average premium on Silver Eagles is about $2 over spot. We're running at more than double the normal premium, and it's been this way for over a year now. Why? Because there's not enough physical silver to meet demand. The mints can't keep up. The U.S. Mint has been rationing Silver Eagles to dealers since 2020. They're producing them as fast as they can, and it's not enough. The Royal Canadian Mint is in the same situation. The Perth Mint in Australia is in the same situation. Every major mint in the world is running at full capacity and still can't meet demand. Meanwhile, the COMEX silver inventories are at multi-year lows. Registered silver, that's the silver that's actually available for delivery, is down to 40 million ounces. That sounds like a lot until you realize that's only about $1.2 billion worth of silver backing a market with over $100 billion in open interest. Let me put that in perspective. If just 1% of the paper silver market demanded physical delivery, the COMEX would be completely empty. 1%. That's how fragile this system is right now. And some people are starting to figure this out. That's what that deleted Reddit post was really about. That dealer in Texas wasn't just selling silver at spot price. He was trying to acquire physical silver by offering spot price to buyers, which would let him turn around and sell it at a premium to someone else. But someone didn't want that information getting out. Someone didn't want people to know that dealers are so desperate for physical silver that they're willing to sell at spot just to get inventory. Now I know what you're thinking. If there's such a shortage, why isn't the spot price going up? Great question. And the answer reveals everything about how this market actually works. The spot price is set by paper trading, futures contracts, options, ETFs, derivatives. For every ounce of physical silver that trades, there are probably 100 ounces of paper silver that trades. Maybe more. The paper market is massive compared to the physical market, and the paper market is controlled by a handful of large banks. We know this because they've been caught manipulating it. JP Morgan paid almost $1 billion in fines for spoofing the silver market. Deutsche Bank settled for manipulation charges. UBS settled. HSBC settled. These aren't conspiracy theories. These are documented facts with legal settlements. But here's what's changing. The physical market is starting to overwhelm the paper market. It's happening slowly, but it's happening. And when it fully breaks, when the premium gets so high that people stop looking at spot price entirely, that's when silver is going to move in a way that most people aren't prepared for. Let me show you what this looks like in practice. Right now, if you want to buy 100 ounces of Silver Eagles, you're paying about $3,300. That's spot plus premium. If you want to sell those same 100 ounces back to a dealer tomorrow, you're getting about $2,700. You're losing $600 on a round trip, even though the spot price hasn't moved at all. That's a terrible investment, right? That's why people say silver is a bad investment. But here's what they're missing. That spread exists because of the shortage, and that shortage is getting worse, not better. Which means one of two things has to happen. Either premiums have to come down, which would require a massive increase in supply that isn't coming, or spot price has to go up to meet the physical market. And there's evidence that the second option is already starting to happen. Look at what's happened in the last 6 months. Silver spot has gone from $23 to $29. That's a 26% increase. But premiums haven't come down at all. They've stayed elevated. That tells you that demand is increasing faster than supply, even as the price rises. Now, let me connect this to something bigger that's happening in the gold market, because it's all related. And this is where it gets really interesting for anyone thinking about their retirement accounts. Gold premiums are also elevated right now, but not as much as silver. Gold Eagles are running about $50 to $70 over spot on a $2,000 product. That's about 3%, much lower than silver's 17%. Why? Because gold supply is more stable. Gold mines are producing consistently. Gold recycling is steady. The gold market is more mature. But here's what's fascinating. The gold to silver ratio right now is about 90 to 1. That means 1 ounce of gold costs 90 times what 1 ounce of silver costs. Historically, that ratio averages around 60 to 1. It's been as low as 15 to 1. Right now, at 90 to 1, silver is historically cheap compared to gold. And if you're sitting on $100,000 or more in retirement accounts, this is something worth paying attention to. I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, what the costs actually are, and how to avoid the common mistakes people make. Worth checking out if you're thinking about protecting your retirement savings with precious metals. But back to this ratio, because it matters for silver specifically. When the ratio is this high, it means one of two things is going to happen. Either gold is going to fall, or silver is going to rise. Or both. And given what's happening with inflation, with currency debasement, with central bank buying, gold probably isn't going to fall. Which means silver has to rise to bring that ratio back to historical norms. If silver just goes back to a 60-to-1 ratio and gold stays where it is, silver would be at $44 an ounce. That's a 50% increase from current spot price, and that's just to get back to the historical average. If we get a real precious metals bull market, like we saw in 2011, that ratio could go to 30-to-1 or lower. That would put silver at $88 an ounce or higher. Now, I'm not saying that's going to happen tomorrow. I'm not even saying it's going to happen this year. But I am saying that the setup is there. The fundamentals are there. The supply shortage is there. The premium structure is there. Everything is pointing in the same direction. And here's the thing about silver that makes it different from gold. Silver is both a monetary metal and an industrial metal. Gold is mostly monetary. It's jewelry and investment. Silver is in your phone. It's in your solar panels. It's in your car. It's in medical equipment. It's in electronics. Every year, about half of all silver mined gets used up in industrial applications and never comes back. That means the above-ground supply of silver is actually shrinking, even as demand is increasing. We're mining about 800 million ounces of silver per year. We're using about 1 billion ounces per year. That 200 million ounce deficit has to come from somewhere. It's coming from above-ground stockpiles. And those stockpiles are getting smaller every year. The U.S. government used to have billions of ounces of silver in strategic reserves. You know how much they have now? 0. They sold it all. China used to export silver. Now they're importing it. India used to export silver. Now they're importing it. The flow of silver has completely reversed in the last 20 years. And now we're seeing the green energy revolution, which is massively silver-intensive. Every solar panel uses about 20 grams of silver. Sounds small, right? But we're installing hundreds of millions of solar panels per year now. That's thousands of tons of silver going into solar panels annually. And that number is growing. Electric vehicles use more silver than regular cars. 5G infrastructure uses more silver than 4G. The entire technology revolution is built on silver. And we're not mining enough of it to keep up. So when someone offers you silver at spot price, what they're really offering you is access to a price that doesn't reflect the actual supply and demand fundamentals. They're offering you a price that's being held down by paper trading, while the physical market is screaming that silver is undervalued. And the smart money knows this. Look at what the big players are doing. Eric Sprott, one of the most successful precious metals investors in history, has been buying silver aggressively. Rick Rule, another legendary resource investor, has said publicly that silver is the most undervalued asset he's tracking. Keith Neumeyer, CEO of First Majestic Silver, has been buying his own stock and holding back silver production because he thinks prices are too low. These aren't random retail investors. These are people who have made hundreds of millions of dollars in the resource sector. And they're all saying the same thing. Silver is cheap. But here's the catch. You can't actually buy silver at spot price. So when you see those advertisements, when you see those deals, understand what you're really looking at. You're looking at marketing. You're looking at a way to get you interested so they can sell you silver at the real price, which is spot plus premium. And that premium? That premium is the real price. That's what silver actually costs in the physical market. The spot price is just a reference point. It's a number on a screen that represents a market you can't access. So what should you do with this information? Well, first, stop waiting for premiums to come down. They're not coming down. They're a feature of the market now, not a bug. If you want to own physical silver, you're going to pay the premium. The question is whether you pay it now or whether you pay it later when spot price is higher and premiums are still elevated. Second, understand that the premium is actually telling you something valuable. It's telling you that physical silver is scarce. It's telling you that demand exceeds supply. It's telling you that the paper price and the physical price are diverging. All of those things are bullish signals. Third, if you're going to buy silver, buy the most liquid forms. Silver eagles, Canadian maples. These are the coins that will be easiest to sell when you want to exit. Yes, they have higher premiums, but they also have higher resale values. Generic rounds might be cheaper to buy, but they're harder to sell, and you'll get less for them when you do. Fourth, think about silver as a long-term hold. If you're buying silver hoping to flip it in 3 months, you're probably going to be disappointed. The spread is too wide. You need silver to move significantly just to break even. But if you're buying silver as a 5-year or 10-year hold, as a hedge against currency debasement, as a way to preserve purchasing power, then the current premium structure doesn't matter as much. And fifth, pay attention to what's happening in the physical market, not just the spot price. Watch the premiums. Watch the mint production numbers. Watch the dealer inventories. Those are the real indicators of where silver is headed. Because here's what I think is going to happen over the next 12 to 18 months. I think we're going to see spot price continue to grind higher. I think we're going to see premiums stay elevated or even increase. And I think we're going to see more and more people realize that the paper price and the physical price are two different things. And when that realization becomes widespread, when enough people understand that spot price is just a reference point and not an actual price you can buy at, that's when the real move happens. That's when silver breaks out of this $25 to $30 range it's been stuck in and moves to 40, 50, maybe higher. The setup is there. The fundamentals are there. The shortage is there. The only thing missing is the catalyst. And that catalyst could be anything. It could be another banking crisis. It could be a currency crisis. It could be a supply disruption at a major mine. It could be a large institution deciding to take physical delivery. It could be a country deciding to back their currency with silver. Any of those things could be the spark that lights this fire. And when it happens, it's going to happen fast. Silver moves violently when it moves. We saw it in 2011 when silver went from $18 to $49 in less than a year. We saw it in 2020 when silver went from $12 to $29 in 5 months. When silver moves, it doesn't mess around. And the people who are going to profit from that move are the people who are buying now, while everyone else is complaining about premiums. They're the ones who understand that the premium is the price. They're the ones who understand that spot price is just a number on a screen. They're the ones who are looking at the physical market and seeing the shortage that's building. So the next time you see an ad for silver at spot price, don't get excited. Get suspicious. Ask yourself, why would anyone sell silver at spot price when they could sell it at spot plus $4? Ask yourself, what's the catch? Ask yourself, what are they not telling me? Because in this market, if something sounds too good to be true, it probably is. And if someone's offering you silver at spot price, they're either lying, or they're about to explain why you can't actually get silver at spot price. Or they're trying to acquire physical silver themselves by offering spot to sellers. The real opportunity isn't in finding silver at spot price. The real opportunity is in understanding why you can't find silver at spot price, and what that means for where silver is headed next. Because that premium, that spread between paper and physical, that's not a cost, that's information. And right now, that information is screaming that silver is undervalued, undersupplied, and underappreciated. The smart money is buying. The question is, are you?